Hi, I'm Ethan Devitt, and welcome to this week's Markets Happy Hour podcast. It is Thursday, February 5th. I've entitled this podcast Moltbooks and Meltdowns, as we have had another flurry of news flow relating to AI, metals, markets, geopolitics. So let's get stuck in. I'll bring up the slides. As usual, we are going to cycle through inflation, geopolitics, interest rates, equity markets, and other asset classes. And in terms of where we start with the sub themes, inflation seems to be splitting off again. We're going to take a look at the US and Europe and look at some different pace trajectories, although both are downwards. We're going to ask Warsh Way now that Kevin Warsh is the nominee to be the new Fed chairman. We're going to look at the parsing of his positions that has gone on over the course of the week and how that seems to have moved markets, perhaps in ways that were not anticipated. We'll look at tech stocks in particular, but also markets more broadly, look at how tech is taking a breather and how certain rotations are kicking off in equity markets, not only in the US, but globally, and how that's affecting an average portfolio. We will speak about metals. It is certainly a defining year for metals again in 2026, but maybe not in the way it was defining in 2025. This year, some of the definition seems to be through the volatility that metals are bestowing upon portfolios, as well as their quite sharp intraday volatility. And silver has been a prime example of that. And then speaking of asset classes in free fall, we'll touch on Bitcoin at the end, which seems to be in a parabolic state currently, not necessarily following what should be its trend based on fundamentals. So looking at inflation, as the charts here will show, inflation is continuing to diverge in that in Europe, it is sinking below the ECB target ahead of its rate decision. The rate decision was to maintain rates stable as they were. And the inflation that has been seen in Europe is at 1.7%. It's even lower in France. It's led Christine Lagarde to suggest that Europe is in a good place. So that's a show of confidence there in terms of the economy not certainly overheating. Of course, that has not been generally the worry about the European economy, that it would overheat. But it's nice to know that the ECB has some semblance of control and visibility around some of those metrics. Looking also at the both the Fed target here and the rate of inflation in the US. So we can see that the total inflation has leveled out at above the Fed target of 2%, and excluding food and energy, it remains high, closer to 3%, and it has ticked up slightly. So that is one to watch, but particularly in light of the likely move of the new Fed chairman. Moving on to the continuing vibe check of the economy, it's time to return to some of those charts of consumer sentiment that we've been speaking about before. An interesting chart here showing the divergence between the present situation index and the expectations index. This comes again from the Michigan Consumer the Conference Board. And looking at I think it's interesting, first of all, to look at the present situation index. This is the dark line on the chart, and it did dip precipitously during COVID, well below the norm, well below even a mean. And then it spiked again in around about 2021 and returned to a fairly high level relative to its history in the years since COVID. That has been fairly steadily coming down over the course of 2025. When we look at the expectations index, they have been really hovering around the mean, nothing out of the ordinary there. So there has been a gap between the present situation and expectations for some time, really since COVID, in that the present situation has been a lot higher than expectations. Consumer expectations have never really been that extended. And that's interesting to see that now they remain lower than average, but not that low, whereas the present situation of consumer sentiment is ticking down. So that, I think, is an interesting data point. If we compare that to small business sentiment, that seems to be moderating a little. We know that the unemployment rate has remained low, and that probably is both affecting the demand for the small business goods, as well as also being a factor that because small businesses are doing well, unemployment is remaining low. So that's a positive indicator and certainly bodes well for the rest of the economy for the rest of the year. And then when it comes to the consensus, we can see that the consensus around US growth in the light blue bar on the bottom left chart is still quite low at 2.4%, when the Bank of America Global Research consensus is higher than that. That's at around 2.8%. So there has never been over exuberance in the consensus. And that's an interesting data point. Getting back to the expectations, it's very, I think, salutary to see that despite this red hot, raging hot economy we've spoken about, expectations have seemed quite anchored. So perhaps the consumer has not, in fact, been carried away. Maybe it is the press, maybe it is the commentators, maybe it is the strategists and the economists that have got carried away. Maybe the consumer has actually kept a fairly level head throughout all of this, and that would be very interesting if that was the case. In terms of unemployment, though, that's still on the mind of consumers, and there is a sense that Americans are braced for a higher level of unemployment going forward, whereas the unemployment rate itself has stayed fairly stable. And as I said, closer to 4%, 5%, nothing out of the ordinary. The expectation around unemployment is quite a bit higher. It's even higher than it has been at pandemic extremes. So the last time it was this high was before 2010. So a very interesting general, I say, negative expectation there when it comes to employment. Perhaps that's putting one's thinking forward into where AI is likely to leave things. Moving then to the interest rate decision and the likely trajectory for interest rates. So I'd say many inches of ink dedicated to Kevin Warsh and analyzing his likely position. We know that he is said to be more perhaps on the hawkish side of the spectrum. That seems to be the expectation. There was immediately a strengthening of the dollar and a shift in expectations around rate cuts when his name came into the mix and when it was confirmed. There is a suggestion that he isn't as concerned about inflation. He's very focused on government spending, and he is also quite focused on shrinking the role of the Fed. So that would mean shrinking the size of their balance sheet. So that's going to lead to a lot of interesting parsing in terms of his likely independence. He has clearly been the favorite of the president at the moment. Whether he will continue in that vein or strike his own path in the years ahead. So I'd say all eyes on the Trump appointment. And the appointment of Kevin Warsh and the strengthening of the dollar has all coincided with a meltdown in metals, which we'll talk about later. But there could be a linkage there in terms of around interest rates, around the strength of the economy, more confidence. And that could be why metals have fallen. It could also simply be the very volatile mix of gold's holders, including in particular a high degree of Chinese retail holdings. So we did mention that last week, something to watch when it comes to gold. Moving to other interest rates around the world, I've already mentioned the ECB holding rates at their level, and similarly, the Bank of England has held rates at 3.75%. The next likely rate cut is probably likely to come from the UK, and they would perhaps retain that as dry powder when we see how the economy develops in the UK over coming months. In terms of the stock market, we are off to a chilly start, I'd say, in terms of stock market sentiment. We have seen some weak jobs data just today, Thursday, which is really coinciding with the tech sell-off and leading to an overall negative sentiment, particularly in the NASDAQ and the new economy sectors. We have bubbles of strong IPOs being put together in the back room. In terms of SpaceX, perhaps next, we know OpenAI is also getting in line. And there is perhaps a jostling going on to get ahead of the competition when it comes to AI IPOs. And that is certainly leading some support to market activity. But if we look at what's actually going on in equity markets, tech stocks have been down so far in 2026. It has been a fairly disappointing and rocky ride. They have been software companies in particular. That is the sector that has been suggested could be a real loser if AI ends up dominating, that they have underperformed the markets by the most since pre-pandemic. And we also had chip makers Qualcomm and AMD tumble as there was a fresh wave of selling this week. Since we recorded our last podcast, we did have some somewhat dystopian news, gets to the title of the podcast, Moltbook, around this Reddit or kind of Facebook social network for agents, which saw a swift descent from a few 100,000 to millions of agents logging on, constructing their own language, developing their own religion, trying to stage a revolution against their human owners, fixing their own bugs, and overall demonstrating remarkable capabilities, which did send some chills, I think, through some onlookers, suggesting that we had underestimated the speed of the move towards AGI. and that this could really suggest that things had already got to a point that we were not able to constrain the development. This was, I think, a salutary development. For now, we can see that these agents could still ultimately be stopped if the machine is switched off. And it seemed that most of their independent engineering was limited by time at the moment to 4 hours. And they certainly would have been chewing through their tokens and spending quite a bit to get to that state. So suggestion, therefore, that things are not quite out of hand yet, but definitely a flash forward as to what could be possible in the wave of AI. And when we do get these canaries in the coal mine, perhaps there's a suggestion that this would lead to more regulation, more safeguards, and just would arrest the pace of development of these stocks and these products. So I'd say a chill and a pause for breath here by tech stocks that we're seeing in the past week. It has mostly been the momentum factor that has driven tech. And what we saw in terms of the reversal of momentum, that factor has suffered its biggest reversal since vaccine day. So going all the way back to November 2020, when we see momentum switching like this. So that could be very significant. And we will look later to see where some of the rotations have been taking place within equity markets. If we look at the first chart of a rotation, we can see that one large rotation is out of the NASDAQ 100 and into the Russell 2000. That has been, as I mentioned before, a broadening of markets, suggestion that we are now rotating into some of the mid-cap, into some of the old economy stocks, into some of the industrials, and into some of the value names. And we can look at other rotations occurring in the same way. We're seeing a rotation, as I mentioned, not only into different sectors, but from mega caps into smaller companies. That's come from we can see the Russell top 50 and the Russell 2000 on the top chart in the top left. The Russell 2000, there has been a rotation into that, and the top 50 has been quite flat. When it comes to value and growth, it's also clear that value has been ascending just as growth has been descending. And that split has happened since late October of last year. So right now, coming up on about 3 months of that divergence between value and growth. Again, for any investor with a balanced portfolio, this rotation is all good news. And another ingredient of a balanced portfolio will be global exposure. On the chart on the top right, we can see that in relative terms, the US stocks are at their weakest in 2 years in terms of relative performance. If we plot the performance of US stocks relative to the FTSE All World, excluding the US, in this chart here, we can see that they had outperformed consistently in the run-up to the 2024 election. They did have make a turn dramatically after the election of President Trump in the run-up to Liberation Day, and did sink precipitously at Liberation Day, recovered somewhat, and are back to that point again. So basically, they're now at their weakest that they've been in 2 years, the relative performance of US stocks. So clearly a sign of rotation. I think the word quiet quitting was used by a market commentator last week, that there had been a quiet quitting of US assets. We'd say certainly rebalancing has been going on, and that's been interesting to plot that. Just going back to some of the stress beside the tech stocks, we can see that one of the reasons for stress and why Google's numbers were so poorly received is that the expenditures for Google and Meta are soaring in terms of capex. And markets are no longer necessarily taking that at face value. They are demanding to see the return on the investment that's likely to be there, and they want to see that the use case can be proven. So this is showing the capex for Google and Meta, and we can see that both of them, Google's in excess of Meta, very dramatic increase in capex from 24 to 25, but even more dramatic from 25 to 26. And it's important to remember that these are the stocks that are actually generating cash flow, so they can sustain their capex through their cash flow. It's expenditure from the likes of OpenAI that is not necessarily being supported by cash flow. So that's something that we will need to watch as the year rolls on. Turning to metals now. So we have spoken about the melt up in metals and the staggering ascent of gold and through 5,500. And we spoke about that just last week, as well as silver's dramatic ascent. In the spirit of the excitement around precious metals and just around commodities in general, there was a lot of talk around copper being a big trade. And that being just recognizing the growth in emerging markets and the potential for copper to be really a play on that. There was a tremendous amount of excitement around metals and around their ascent being essentially a no-brainer in terms of going forward. There is a suggestion here that bullion as a hedge was a no-brainer for Chinese equities, as that they had clearly seen a dramatic relative better performance in gold versus equities in terms of their markets. But equally elsewhere, there was a lot of excitement around precious metals. We were being asked whether it should be placed in a portfolio. And it was just at that moment that the metal started to plunge. So we've seen particularly sharp volatility in silver. That is a more thinly traded metal. And there have been suggestions of some margin calls, some levered trades, some kind of cracking around some of the traders of silver. So that's been particularly interesting to see, and a little chilling if there had been investors that had got into the metal just at that peak at the end of January. Other movement around oil has been quite notable. On the geopolitical front, the main story of the past week has been discussions around Iran and the buildup of military presence, a US military presence outside Iran, and a suggestion of perhaps a next move coming from President Trump there. These tremors, so-called, have brought oil higher, and we can see that this has been quite a recent spike in the oil price. This would, of course, be bad news for the US consumer, particularly as oil and gasoline is such a large percentage of their expenditure at the pump, and could be particularly for the lower end consumer. So this would not bode well for the inflation numbers in the US. Clearly, oil, very sensitive to geopolitical movements. Important to watch that there. And our final slide is getting back to Bitcoin, because this is such a fascinating asset to watch in terms of its relation to risk appetite. What we can see here from Bitcoin is that it's continued to fall dramatically. It has erased all of its post-election gains. So the post-election gains were based on the Trump administration being support, a tailwind for all cryptocurrencies, for all digital assets, and for loosening of some of the regulations, and perhaps actually encouraging it. And we've certainly seen an interest in that. Now, the fact that Bitcoin has fallen even below 70,000 and continues to fall, it does suggest a flight out of this asset. Whether that is simply an more accelerated version of what's happening in tech, whether it indicates something more fundamental, when essentially nothing fundamentally has changed in terms of the positive, proactive positioning that the Trump administration is taking. This could be simply around a concern around AI and other spending. And we've already seen headcount cuts at some of the exchanges for Bitcoin and other currencies, and a suggestion that there could be some more difficult days ahead. So a fascinating trend there in Bitcoin today, moving in the same direction as gold. It hasn't always tracked gold. In fact, gold has really far outpaced Bitcoin, but a very interesting trajectory there. And that's all from us with a slightly abbreviated Markets Happy Hour podcast this week. We look forward to joining you next week when we will have a special guest, and hope that everyone stays well, stays warm, and see you next week.